Hello, everyone. This is Richard Wilson with the Family Office Club. We have with us here Erwin. Thanks for joining us, Erwin.
No, good morning. Thank you for having me.
Great. And we're here doing an investor mandate interview to figure out what you're looking to invest in, what you're looking to source. We just talked a minute ago about how you're flying around on airplanes right now, negotiating deals, looking for deals. Whether you're listening to this live or 7 years from now, we're just 5 days after the Armageddon day of the virus kind of being at such a breakout level that the U.S. started to shut down normal business operations, as I guess you could call it. So it's an interesting time. And I'd like you to just describe a little bit about the type of firm you're at, maybe the size of the firm, the type of investor you are before we get into your mandate.
No, that's fine. Sure. It was a third generation real estate family office. There's $850 million of assets under management. At one point, we were in all the food groups in the real estate sector. At this point, I've been a net seller up until last week when sort of the market stopped on multifamily. We've been a big buyer of suburban office and really a lot of logistics and flex office. We invest for current return for the family because that's how the family does its philanthropic work in addition to paying bills. So we're yield driven. So it's kind of an interesting time. And given, the Armageddon that happened last week, I don't really see rates going negative. I think the Fed and if they do go negative, I think that people are really out there looking for current return more importantly than anything else. And so,
Right.
Our mandate is to look for deals that provide stable levels of current return. We're not taking any construction risks because we've seen a lot of state and local governments sort of stop or halt their construction process. And with everybody sort of sheltering in place, I don't think you can get employees to complete anything on time. So it's really what's in place today. Is it a sector like industrial or flex where we know who the tenants are? We've been doing it for 20 years. Do we know how they're going to be affected by this pandemic situation that we're in? And do we think they're going to come back and look for some rent abatement or not?
Great. Yeah, we have our average client net worth of the investors that we work with most closely is 22 million net worth right now, but we have many families that are in the hundreds of millions of net worth. My experience with them is that if they can get a 10% plus income with a good piece of collateral, a good quality asset behind it, then they feel good about that. If they can get 12 to 15%, that's great, but anywhere close to 15% probably has a lot of risk or some sort of risk that's perceived on the back end. And most investors that I work with get a bit bored if you talk to them about a 7 or 8% income stream, unless there's also some upside on the valuation, et cetera. So what type of income levels, I'm sure it's specific on the asset and whether it's Nashville or New York City, et cetera. But in terms of a general yield expectation that gets your interest before the crisis in a normal quote unquote world, and then now, what type of yield numbers do you guys talk about internally as being acceptable, or so high it's probably risky, or so low it's not even worth looking at?
Well, even before this more recent blip we've had, we've always been looking to try to at least get double-digit cash flow.
Okay.
It's not out of the box, and by year two, whether it's through a value add, through marking leases up to market on renewals with new tenants. But now we're seeing, because of some of the displacement and some of the sort of everybody, the flight to quality, and some of the bigger players really displacing a lot of the smaller tenants as they look to rent to larger, more institutional tenants. So we're seeing the yields really come up in some markets. We own a lot of stuff in Syracuse and upstate New York, industrial and flex. And now I can buy almost on a 10% unlevered return. So if I'm going into the 10 and I take 60% leverage, I'm at 15 current, and I really don't have any risk because the people need to be there off the major roadways or the railways. And so, we tend to look for stuff that's not the A location because the B's and the C's are staying full. At least that's been our experience over the last 15 years. And I'd rather be the low cost provider than have the shiny new toy that's empty.
Right. Okay. And if you were to order 1, 2, and 3, the types of assets that you're looking for, and maybe a little bit about the regions that those would be in, what are you looking to receive in terms of deal flow from the Family Office Club?
Sure. We generally look for major roadways. So right now we're really in pursuit on buying another 5 or 6 million square feet of logistics and flex.
Okay.
So I'm looking 65, 75, 85 north to south. We're looking 20 and 80 east to west. To the extent I could find something that's within a few miles of a port, like we saw a deal that one of the funds is selling 2 miles out of Baltimore, which we kind of like. But we're looking for deals that have good history, good occupancy history, tenants that aren't subject to whatever the occupancy or gathering new restrictions are under the social distancing. Right. Like normally you'd find in some of these locations, secondary locations, you might find a house of worship because you can't get zoning to build another one. But when you can't have more than 50 people, in a house of worship, I think they're going to have trouble paying their rent. So right. We saw one of those in a great location outside the Beltway in DC, but with this recent sort of limit on how many people you could occupy it with, we decided to pass on it. But so it's major rails, major roadways, access to ports. It's got to serve a purpose.
Sure. Okay. What is the number one thing that's most specific that you would like to source? If you're talking to your team and you say, what we need to spend the most of our time on is this one very specific type of asset. Is it basically what you just described, or is there another type or an even more specific description that's going to help you get that from our organization?
It's really multi-tenanted, flex and industrial. We've had experience with single assets where I have Staples in 650,000 feet, and when they go out, your lender's trapping your cash flow if it's financed, and then you have to figure out, you slice it into 2, 3, or 4 spaces. So multi-tenant is great. Small bay industrial is great. It spreads the risk. It's almost, like the same risk sharing profile as having an apartment building with 300 units. You figure, 90% of them should always be full.
Sure. Yeah, makes sense. What is your $100,000 piece of advice that you could provide for other investors who listen to this? Maybe it's going to save them $100,000 in fees, wasted time, a busted deal, paying too much for financing, something you've been burned on. They don't need to if they would just listen to this one piece of advice. What's something you could share with other investors here?
Sure. I would say that you got to make your money on the buy. So you can't really overpay saying, well, you're going to make it up at a value add or you're going to make it up in rent increases in year 2 or 3, because, man makes plans and God laughs. We've all been in that situation where, you say to yourself, well, hindsight's 20/20. So you can't go out and project, especially where we are today. So don't worry if you're not the high bidder. Chances are the high bidder or the second high bidder, they're not going to be there. That's what we've been seeing lately. Sellers have some flexibility. It's the brokers really if it's a broker deal that are pushing the numbers. If sellers need to sell, they're going to transact even if you're 5 or 6 or even 10% off what the broker's telling you.
Right.
That's our experience this week. I would say do a lot of due diligence. So not only do you want to really look at what the historical financials are, we go out and we almost do an audit. We vouch cash. I look at the last 2 years of bank statements. I compare it to the general ledgers and the cash receipts. And so no one's going to, I can understand if you're going to falsify, your collections, it's not going to be for the last 2 or 3 years. It's maybe going to be the last 6 months or maybe even a year if you were pumping up the cash. And really spend some time talking to the tenants. What are their needs? Have they outgrown the space? Do they think they have too much space? What do they think their business outlook is? Because that'll at least tell you whether the tenant is a sticky tenant and they're going to stay and renew, even if it's not at a large increase, or maybe they want to give back space. And if you can have a better feel for what's going to happen with the property going forward, that's some of the risks that you could help underwrite and at least, figure in what your worst case scenario might be after you close.
Sure. Yeah, no, that makes sense. I mean, I guess on your comment on pricing, when you compete against an independent sponsor or a fund that throws out a big offer, especially an independent sponsor that might not have the money on their balance sheet, I'm guessing you compete well against them in a normal environment. But in this environment, people might be even less confident of someone that doesn't already have their capital 100% put together coming to the table and not having those proof of funds from an organization like yourself or an independent sponsor. When they compare those two, they're going to take that lower offer from someone they think can close, because you also now have the risk of the bank not wanting to close or them underwriting the asset. The bank might value the asset lower when it gets appraised. No one knows what the new appraised value should be. So you might be required to put more cash down at the last minute. And all those things must give you a major advantage in this type of a market. I'm guessing. I don't know if you're seeing that yet because you're traveling so much. And
No, we are seeing that yet. There's one asset we looked at between 95 and the Port of Baltimore, where we were involved on making an offer. It wasn't the highest offer, but the offer included $250,000 of non-refundable money on contract, and we know there were institutional bidders in that market by the port. And when it came time for the buyer interview, we found out that a lot of those guys are hoarding cash for funds because they have a fiduciary responsibility to really protect the existing assets in the fund. And so some of them are stepping back from new acquisitions. And we told the seller, we were no longer, given the state of the economy and what's going on, that we were no longer going to offer hard money. And they said, we understand. So you'd be surprised what's really happening live time. And it's having the ability to really feel people out when you get on the phone with the seller. And don't really let the broker get in your way. You really want to talk to the operating partner, and you'll always get the equity partner on the phone as well as part of these interview process. And so you really, if you're good with people and good with speaking to people, you'll be able to hear what's not being said.
Right.
And that really separates, success from failure. It'll separate you from necessarily offering too much, because they really want to get comfortable that, yes, we have the equity. We've done deals with these, 6 people forever. It's discretionary, even if it's not all our money, but it's a pool of partners that have done this together. We have substantial assets under management, and you have great references. So I think that, if you're someone that can pull it all together, I think, at least for the near future, you're going to have an advantage.
Right. Yeah, it seems like it. So, I appreciate you sharing here. And I know that a few of our members have met you at some of our investor summits before. So I appreciate you speaking at our event in San Francisco and at, at least half a dozen events over the last 7 or 8 years. So appreciate that. And what's the best way for someone to get a hold of you if they want to follow up and contact you directly?
I'm searchable on the internet, almost too searchable. They can feel free to email. They can give me a phone call. My cell phone is actually posted on my LinkedIn profile.
Cool.
So,
all right.
Because it's all about meeting people and networking.
Sure.
I find that, the people that I've met at some of your functions like a year or two ago, one of them actually, I said to them, hey, I know guys own a lot of stuff with Amazon. I'm looking at this deal. This was like on a Thursday. They said, great, we'll meet you there on Monday. And I'm like, wow, you guys are fast.
That's great. That's awesome. Yeah, and I appreciate you mentioning that. Yeah.
No, but I've actually had some good success with a few people that I've met at your function. So people that are, that actually operate funds, people that are sponsors, and we've met a bunch of really great people. It's one of the conferences that I actually look, forward to going to, where I find that at some of the conferences you go to, all you get is vendors calling you, and I don't have time for that.
Right. Great. No, I appreciate you saying that. I wasn't planning on trying to get you to give us a little testimonial for 30 seconds there, but appreciate that happened. And looking forward, once we get our events resumed, seeing you at one of our future events. And thank you for sharing your mandate here with us today.
Sure. Thank you.
It. Take care, everyone.
Sure. Thanks, Richard. Bye-bye.
Bye.